Hi, I'm Mark Anderson, a loan officer at Cornerstone Mortgage based in St. Louis, Missouri. I hold a residential license in Missouri, Illinois, and Kansas. For today's video, I wanted to talk about private mortgage insurance, or PMI for short. I want to talk about what it is, why it actually benefits the consumer, and some different strategies that you may not have heard of to minimize the damage when it comes to paying for PMI if it ends up being a factor on your loan. For starters, PMI is actually an insurance policy to benefit the bank in the case of a foreclosure. Now, the reason that this insurance exists and the benefit for you as the consumer is that the very existence of private mortgage insurance is what allows you to make less than 20% down. In today's market, on a conventional 30-year fixed loan, you can technically put down as little as 3% of the purchase price. On an FHA loan, which is a government-sponsored loan program, you can put just 3.5% down. In both cases, the reason that this product is out there is due to the existence of PMI. Okay? So now that we understand what PMI is, let's discuss some strategies, some different options for how you can pay for PMI. Traditionally, PMI is a monthly fee. You pay the principal and interest that's based on the interest rate that you have on the loan. You pay your property taxes. You pay your homeowner's insurance. And PMI, let's say you're putting 5% down, PMI is going to be a monthly fee on top of all those other things. Okay? Most lenders today, although there are other options available, and there have been for years now, most lenders, if you ask them, they're really only going to give you this traditional monthly PMI option. And as we're going to see, it's actually the worst option out of the other options that are available. Now, I'm going to share some specific numbers in the video description to actually go through the math, but let me just explain a couple of the concepts for now. Instead of paying a monthly private mortgage insurance premium, there are really two other ways that you can handle it. The first one we'll talk about is called a single premium PMI option, or sometimes called lump sum PMI. Now, lump sum is a great option if, after making that 5%, 10% down payment, if you happen to have a few thousand extra dollars left over. And the actual amount of this single lump sum payment is going to depend on many different factors. But essentially, here's how it works. Instead of paying that extra fee every month for PMI, you get rid of it entirely in exchange for an upfront premium that you pay at closing in addition to all of your other closing costs. Now, the nice thing about this is that the way that the math works out is that the amount that you pay up front beats the monthly option usually within about 3 years. So as long as it's your plan to live in the property for, say, 3 years or more, and you have this extra money lying around that you can apply toward your loan, it's going to be the best option mathematically out of anything on the table. And you're going to save a lot of money by going that direction. Okay? Now, there is a third option that if you don't have the money available for the lump sum, which let's face it, if you're putting 5% down, that may be because you want to still hold on to some savings. If you don't have enough money for the lump sum single premium option, there's an option in the middle. It's still way better than the traditional monthly PMI. Instead of paying the additional fee per month, and instead of paying the lump sum, what you can do is take a program called lender-paid mortgage insurance. Now, what happens behind the scenes is that lump sum option, instead of you paying that at closing, the lender pays it for you. Now, we do this in exchange for a higher interest rate. At first, it's going to seem absolutely the wrong thing to do, and psychologically, it just seems wrong to take a higher interest rate. But in many cases, you're only talking about maybe 1/4 or 3/8 of a percentage point to completely eliminate PMI for the life of the loan. Now, again, I'm going to share the math for a particular scenario in the description for this video. But those are a couple alternative PMI strategies, which I'm just going to say 9 times out of 10, for the vast majority of people, are more cost-effective mathematically than the traditional approach that you're going to get with most lenders. So if you'd like me to take a look at a custom scenario for you, I'm happy to do so. As always, you can find me on my website, markandersonmortgage.com. You can call or text 314-599-0511. Thank you.